Last month, I studied thousands of double tops and double bottoms in the hopes of finding a way to predict their success. After reviewing hundreds of patterns, I discovered something. I found a few secrets inside those chart patterns that improved the odds of their success. Secrets like the placement of the tops and bottoms, or using it with divergence. In this video I will share those secrets to finding high-quality double tops and double bottoms that you can use to drastically improve your win rate. We will first review the structure of double tops and double bottoms, then move on to the secrets. Even if you are familiar with the patterns, you should not skip any parts of the video. Watch it until the end because each minute of the video is filled with valuable information. With that being said, let's get started with the double tops. Double tops. The double top pattern is a bearish reversal pattern. It occurs at the end of an uptrend, when the buyers get exhausted and the upwards momentum slows down. We see two tops around the same price area, with a valley in the middle. According to textbook rules, the tops don't need to be exactly equal, but as long as they look similar, the pattern is good to go. We draw a line at the valley, which becomes the neckline of the pattern. When the price breaks below the neckline, we enter a short trade, then we measure the distance between the neckline and the top. We add that distance below the neckline to mark our targets for the trade. The ideal stop-loss placement for the double top is right above the neckline. Double bottoms. Double bottoms are just the opposite. It is a bullish reversal pattern. The pattern occurs towards the end of a downtrend, when the sellers get exhausted and the downward momentum slows down. We see two bottoms around the same price area, with a peak in the middle. As I said earlier, the bottoms don't need to be exactly equal, but as long as they look similar, the pattern is good to go. We extend a line at the peak to create our neckline. When the price breaks above the neckline, this becomes our entry trigger. We enter a long trade. Then we measure the distance between the neckline and the bottoms. We project that distance above the neckline to mark our targets. We place our stop loss below the neckline and wait for the price to either achieve our target or hit our stop loss. So that was the basics of the patterns. Now that we have revised the basic structure, let's move on to the 3 secrets that can help you find high-quality double tops and double bottoms. Secret 1: Price action cues. When analyzing the double tops and bottoms, looking for price action cues is crucial. For example, in a double top pattern, observe the position of the second top in relation to the first one. If the second top is slightly below the first one, it is considered a high probability trade. This indicates that the sellers who sold at the first top are strong enough to prevent the price from breaching or testing it. In other words, the sellers are in control and they are reversing the price even before it reaches the prior top. This shift in the trend from bullish to bearish suggests that the price is likely to fall further. As a result, entering a short trade is a good idea. Here is an example. Here we see that the price makes an up move, a pullback followed by a final attempt for an up move. But this time the price fails to breach the prior high. The price would have broken this high if the buyers were in control. Instead, the sellers who sold at this high were strong enough to overcome the buyers, so they pushed the prices downwards. The lower top makes this a high probability pattern, so we enter a short trade on the breakout of the neckline. Now moving on to the double bottom. A high probability double bottom pattern occurs when the second bottom is slightly above the first bottom. This indicates that the buyers who bought at the first bottom are strong enough to prevent the price from breaching or testing it. In other words, the buyers are in control and they are reversing the price even before it reaches the prior bottom. This shift in trend from bearish to bullish suggests that the price is likely to rise. As a result, entering a long trade is a good idea. Here is an example. Here we see the price makes a down move, a pullback followed by a down move again. The second down move is short-lived, as it doesn't even cross the first bottom. The buyers who bought at the first bottom are strong enough to prevent the price from moving down. We see a double bottom pattern with a higher bottom, so we mark this neckline and enter a buy trade at this candle. Paying attention to price action cues, such as the position of the tops and bottoms, is a helpful tool in identifying high-quality double tops and bottoms. While trading in real time, you won't always find price action cues in every double top or bottom, so to address this problem, you can use the second secret. If you are enjoying this video so far, then be sure to hit the like button and subscribe to our channel so that you don't miss any of our future videos. You can also check us out on Instagram by clicking the first link in the description below. Secret No to divergence. Divergence is one of the most effective ways of identifying potential reversals. Double tops and double bottoms are also an effective way of identifying a reversal, so spotting a divergence along with the chart pattern should give us a high probability trade. For those who may not know, divergence occurs when the price and the indicator show different interpretations. A bearish divergence is when the price makes a higher or equal high, but the indicator shows a lower high. This shows that the upward momentum has slowed down, and we might be in for a down move. Similarly, a bullish divergence is when the price makes a lower or equal low, but the indicator makes a higher low. This shows that the downward momentum has stalled, and an up move may be on the cards. Divergence can be spotted on different indicators. We will use the MACD for this video now. When we spot a double top pattern, look over to the MACD for divergence. Now that we see the price made higher tops, but the MACD made lower tops, this is a bearish divergence. This divergence on the MACD tells us that the momentum on the first up move was way higher than the second move. In other words, the price has lost momentum coming into this move. This tells us that the up move is over, and there is a high chance of reversal. Here is an example. We see an up move, a pullback and a subsequent up move. The price creates two equal highs. A double top pattern. But on the MACD we see lower highs. Again a strong bearish divergence. Now we have the confluence of a double top and a MACD divergence, both of them indicating that the price might move downwards. So we enter a short trade on the break of the neckline. And as you see, the price moved downwards. Moving on to the double bottom. When we spot a double bottom pattern, we should look at the MACD for divergence. Here we see that the price makes lower bottoms. On the MACD we see higher bottoms. So this is a bullish divergence. This divergence on the MACD tells us that the momentum on the first down move was way higher than the second move. In other words, the price has lost momentum coming into this down move. This indicates that the down move is over, and an upside reversal may occur very soon. Here is another example. The price makes a double bottom pattern with two equal lows, but on the MACD we see a higher low. This is also a bullish divergence. Now, we have a confluence of the double bottom and the MACD divergence, both indicating that the price might move upwards. We draw a neckline on the pattern and enter a long trade on this candle as it breaks the neckline. And as you can see, the price moved upwards after the entry point. Secret No. 3. RSI confirmation. Many traders say that indicators are lagging and only give a signal after a significant move has occurred. With this secret, I will burst that myth and tell you how you can use the RSI as a leading indicator. The RSI is an oscillator that shows you the momentum of the price Generally, it is used to trade reversals. When RSI is above 70, the price is said to be overbought, so we downside reversal as expected. Similarly, when the RSI goes below 30, the price is said to be oversold, so an upside reversal is expected. But our use case for the indicator is a bit different. We are not going to use these overbought or oversold levels for our trades, so you can remove them from your chart. We only need the RSI on the default 14-period settings for this technique. Here is a double top pattern. The second high is lower than the first high, which makes it a high-quality double top pattern. Now we plot the neckline on the pattern. Then we identify the candle that created the neckline and plot a line on that candle's RSI value. Essentially, we have created a neckline on the price, as well as on the RSI. The secret is that the RSI neckline should be broken before the neckline on the charts. On this candle, the RSI had already broken its neckline. This shows us that the momentum had already shifted downwards, and the price will follow soon. This becomes a high probability trait. So in a way, the RSI has given you a breakout signal before it actually occurs. Here is an example of a double bottom. The second bottom is above the first bottom. This makes it a high probability double bottom pattern. So we draw a neckline of the pattern from this candle. We look at the RSI value on that candle and draw a neckline on the RSI as well. On this candle, we see that the RSI has already broken above its neckline, while the price is still below its neckline. This tells us that the momentum has already shifted upwards. So on this candle, the price finally breaks above its neckline, and we initiate our buy trade. And as you can see, the price made an up move after our entry. So these 3 secrets I shared. Here are just some of the things I discovered. If you have any other secrets, then be sure to comment below. Let's share our knowledge to make each other better. Traders, if you found this video helpful,